You'll need to weigh your options carefully to finance a $430,000 home at a 6.47% rate, which could end up costing you around $1,300 more per month than you anticipated. This video is designed to help first-time home buyers understand the implications of current mortgage rates on their home financing options. By the end of this video, you will learn how to calculate your mortgage payments at a 6.47% interest rate, understand the impact of rising mortgage rates on home affordability, and discover strategies for securing the best mortgage rates as a first-time buyer. What are mortgage rates and how do they work? Mortgage rates, which are currently at 6.47%, are the interest rates charged on a home loan. A jargon term you might hear is APR, which stands for annual percentage rate, and it includes both the interest rate and any additional costs associated with the loan. For a $430,000 home, a 6.47% APR could result in a monthly payment of around $2,700, which is significantly higher than the $2,200 you might have expected at a lower interest rate. How to calculate mortgage payments at 6.47% interest. To calculate your mortgage payments, you can use a mortgage calculator tool. For example, if you're looking at a $430,000 home with a 6.47% interest rate and a 30-year loan term, your monthly payment would be approximately $2,700. This calculation takes into account the principal amount borrowed, the interest rate, and the loan term, giving you a clear picture of what your mortgage payments will be. Impact of rising mortgage rates on home affordability. Rising mortgage rates can significantly impact home affordability. With mortgage rates today at 6.47%, the same $430,000 home that was affordable at a 5% interest rate might now be out of your budget. This is because higher interest rates mean higher monthly payments, which could push your dream home beyond your financial reach. It's essential to consider these changes when planning your home purchase. Strategies for first-time buyers to secure the best mortgage rates. As a first-time buyer, securing the best mortgage rate is crucial. One strategy is to improve your credit score, as a higher credit score can qualify you for lower interest rates. Another approach is to consider different loan terms, such as a 15-year loan instead of a 30-year loan, which might offer a lower interest rate. Additionally, shopping around for mortgage rates and comparing offers from different lenders can help you find the best deal. Using a mortgage calculator to compare home loan options. A mortgage calculator is a valuable tool for comparing different home loan options. By inputting the principal amount, interest rate, and loan term, you can quickly see how different scenarios affect your monthly payments. For instance, you can use a mortgage calculator to compare the monthly payments on a $430,000 home at a 6.47% interest rate versus a 5.5% interest rate, helping you make informed decisions about your home financing. Navigating the current housing market as a first-time buyer. The current housing market, influenced by mortgage rates today, presents both challenges and opportunities for first-time buyers. With higher interest rates, some homes might become more affordable as prices adjust. However, the increased cost of borrowing means you'll need to carefully consider your budget and possibly adjust your expectations. Staying informed about real estate news and trends can help you make the most of the current market conditions. If you're ready to take the next step in your home buying journey, click the link in our description to access our free mortgage calculator tool and start exploring your options. Don't forget to subscribe for more first home buyer tips and strategies to help you navigate the world of mortgage planning.